I would now like to introduce today's presenters. Shirley Hung, partner, is a member of the Business Process Services team. She advises senior stakeholders of global services, including enterprise, service providers, and investors in their strategic mandate and initiatives. Nitish Mittal is a partner in the technology practice leading the firm's coverage of digital transformation and IT services in Europe and the United Kingdom and Ireland. Based out of the London office, he covers technology areas across artificial intelligence, automation, cloud interactive services, and the Internet of Things. Akshat Vaid is a partner and leads engineering services research and advisory at Everest Group. He assists global enterprises on a variety of initiatives across engineering, technology, outsourcing, and ecosystem engagement. He also works with global engineering services providers on business growth strategy, competitiveness, and differentiation. And with that, I would like to turn things over to Shirley.
Thank you so much. We're so excited to be here with you today. I know many of you are in the midst of thinking about, 2024 and developing your strategic and business plans. So that's why we are here today. We're going to start off by recapping what we see in 2023 so far. I know we're 3/4 of the way in, but I think for many of us, we have a perspective on how this year has gone. And then we'll move into looking forward into 2024 and what trends will shape the upcoming year. And finally, we'll wrap up by giving some practical advice around what you should be doing when you're planning out that year going forward. So to kick us off, what I would like to do is to hear from you through a quick poll. We want to understand how you would rate your company's performance or revenue that you've achieved so far in 2023. It's the choices are: have you had a fantastic year? Is it slightly better than expected? About as expected? Has it been a tough year, or has it really been just a miserable year? Your responses are confidential, so please choose the appropriate response for your screen. On your screen. Nitish, as we're waiting for people to respond, what are you hearing from your own market interactions?
Yeah, surely that's a great point. And I was curious to see how many people select option one. And as we see these results, we see it's a very small sliver. And I think the numbers are pretty much in line with what we're seeing as well. To be honest, I think I expected a few more people to select a tough year, but it clearly is the second most impactful option right now amongst the ones. I'm quite surprised, honestly, to see about 41% saying, nearly 2/5, a little over 2/5 saying about as expected. So I think that tells you where the sentiment is. I think, and I also saw a little bit of that, a little bit more in the first half of the year. We're starting to see some of this turnaround slowly in the last few months, but not where we wanted to be.
Great. Well, thank you. As those of you who are familiar with our research, we do ask this question in our annual key issue study, which we'll talk about a little bit later. All right. So over to you, Akshay.
Yeah. Thanks for that. And by the way, just commenting on how the results turned out on the survey that we just saw. I think the two options which were slightly better than expected and about as expected, the fact that people chose some people chose those options is not a reflection on the year, but the fact that they were aware what they were getting into, right? so people were quite familiar that this year is not going to be that great. Which is, by the way, what we're capturing here on the page itself, right? Getting into the year 2023, we were coming out of 2022, which had towards the some year already, right? We were getting out of, actually it wasn't getting over, but we'd kind of seen a whole year globally being dominated by an evolving war situation, some other macro themes like chip shortage, etc. They were playing out and troubling the overall ecosystem in more than one ways. Even some of the large companies had started to show a downturn in their performance. And then as we got into 2023, we started to see some of it unfold even further. We had banking failures, the likes of SVBs, going through the turmoil that we saw them go through. And all of that essentially, put together, what that meant was there were lots of indicators which were showing in red, right? So inflation, high cost of capital and loan volumes, really declining. The fact that getting into the year, the probability of recession was actually quite high, right? That's the nature of what the world was looking like getting into 2023. And I would say that sentiment actually translated into reality as well, as we would see on the next page. To a large extent, that's how the year turned out. What we see on the screen is the performance of service providers, the industry that is being represented by the audience here today. In terms of how the industries shaped up, in terms of how their geographic segments, finally shaped up, at least how it stands today, right? So from that standpoint, as you can see, most of the industries saw a significant downturn. Some fared better than the others, sure, that's the case, and maybe even some which are not shown here, the likes of automotive and maybe aerospace, they fared better than the others. But you see the major, dominant spend segments like BFSI, like TMT, right? There's been a very, very real, struggle. There's been a significant slowdown. So the usual themes which are around modernization, around new product development, and so on, we saw a downturn there. Similarly, if you look at the geographic breakdown, the largest segment for most industries within the BPS, ITS, and engineering areas, the North American region has seen a fairly, or most of the ecosystem entities in the services industry. But that said, I would also say that this is also not completely pessimistic, right? While there has been a slowdown in growth in most of the segments that we spoke about, it is still growth. It's not a downturn completely. The spends haven't gone down from where they used to be in the last few years. It's not all as bad, and maybe to talk more about that, I'll invite Nitish.
Yeah, thanks, Akshat. And you're right. I think if you think of the headwinds as well as the tailwinds for this market, we spent a lot of time talking about why people believe that it's been a bad year, right? And I think if you think of some of the volume cuts that we are seeing or rationalization, we're also seeing some of the large deals that are still happening in the market, but often have a delay in ramp up or revenue recognition. We're also starting to see vendor or scope consolidation in certain accounts as people take a cost optimization playbook, along with how they think of deferring spend even after signing on. So, for instance, we see book to bill volumes and pipelines to be fairly healthy for the market, but that recognition in terms of revenue and growth has decoupled. And some of it, frankly, is also relative, right? Because the last 2 years we saw a blazing amount of growth as we saw this one-time spend in the pandemic on digital resilience, and this overall shifting of technology, business process, and engineering priorities to become less focused or less dependent on just GDP growth. Having said that, I think there is hope on the horizon. We believe a lot of the spend that we're talking about is not discretionary spend. A lot of that has become fairly recession proof, and some of the deal pipelines numbers we are seeing in the market, about 1.15x in terms of book to bill on an average, is nearly an all-time high. So that does portend that there is enough confidence on clients signing off. It's just about how do we execute. We still believe there's a lot of opportunity for providers in expanding into existing accounts. We do believe account farming and distinctive client services and making sure you're close to your key accounts will be an important area of short to near-term growth. And then we also believe that there's going to be new logo addition, specifically in the mid-market, if you can place your bets well. And we as we think about inflation cooling off in most geographies, some consumer confidence coming back slowly, we do expect bookings overall to also improve conversion. So it's not all bad news. And so, we spoke a little bit about the retrospective view. Let's also talk about what's happening or is going to happen. So this chart represents, organic and constant currency growth, historical, as well as our forecast for business process services and IT services. In fact, if you put engineering also on this, that number is slightly higher, close to 10%. So, what we see in IT services, the area I focus on a little bit more, we see that number is going to be, it's going to see a little bit of a bounce back over the next 12 months, closer to 4%. In fact, we believe if you take a 2-year horizon, up till 2025, that number is going to flow back to 6%. And what's important to note is, yes, this appears like a sharp deceleration from where we were a year or 2 years ago. But if you were to just zoom a little bit left in this chart and look at where we were in March 2020, just when the pandemic started, or March 19, even a year before, these numbers are significantly higher than where we were going into the pandemic, indicating that the floor for growth and our expectations have been reset. And surely I'm assuming we're seeing something similar on the business process side as well.
Yes, absolutely. We've talked quite often in the past about business process services tending to be quite resilient during economic downturns. Primarily, it's because companies see outsourcing as a lever to derive benefits such as, immediate cost savings or to achieve agility in handling volume fluctuations. And I think that this chart demonstrates that point very well. As you were saying, the year-on-year growth rates for BPS, as well as normalizing at a higher point than the pre-COVID levels. All right, moving on to looking forward into 2024. What we want to talk about here is give a perspective on 5 key demand themes that we're seeing. As industry analysts, we speak to all kinds of stakeholders in the market on a daily basis. And here we want to call out what we're hearing from buyers or enterprise stakeholders, which you as providers should take into consideration when you're formulating your business plans. We'll go into each of these in a bit more detail in the section, but at a high level, we'll be discussing where there are opportunities for growth, what we mean by platform-led service models being a critical area of focus, how account management can be a competitive differentiator, how you can support your clients and prospects' GBS or shared services journeys. And finally, of course, we can't let an opportunity go by without talking about generative AI, but also the other key trend that we're seeing, which is sustainability services, and how these two factor into your strategic plans. So diving into where the opportunities exist to drive growth. I'll start out with the BPS view. We call out a few key segments here where we're seeing strong growth. As you can see, digital CXM or customer experience management services. These are services that are typically delivered out of a contact center environment. It's been growing steadily and strongly for the past few years, but we do see that this trend will accelerate with the leverage of both traditional and generative AI. Organizations are looking to leverage these technologies to deliver better and more human-like customer experiences. And it's widely accepted that contact centers toward the top of the areas where AI will have a huge impact. However, we still expect some growth in traditional CXM in the short term, which is based on the continued increased willingness by companies to invest in customer experience even through economic downturns. We also see strong growth continuing for service areas such as financial crime and compliance, marketing services, and supply chain management. As companies become more comfortable with outsourcing and offshoring models, their appetite for outsourcing processes, which are more sensitive to their operations, increase. And while these segments are still relatively small, increased outsourcing penetration is driving growth rates of around 20% or more. Low growth in recruitment process services is tied to the economic conditions that we're seeing now. Over-hiring happened in 2021 and 2022, and recruitment volumes started reducing in 2023, which we feel may continue into 2024, and that's why it's showing low growth potential.
No, that's really interesting. And I think some similar trends, surely in IT services, right, which is on the extreme right of this chart here. I think the three areas where we see relatively high growth are application development and management, enterprise platforms, and cloud services. Very different reasons. I think on application development management, most clients or large organizations who are now pivoting to becoming technology-first organizations have increased the velocity and throughput of the number of applications that they manage and develop. Thereby, necessitating newer models of managing this, as well as thinking about developer productivity. It's not a surprise that if you think of the early use cases of generative AI are focused on software and developer productivity, which has stalled for a number of years now. This is quickly followed by enterprise platform services. This is the platform economy around Salesforce, Adobe, Oracle, SAP, ServiceNow, Workday, and so on. And clearly, there is a consolidation of the tech stack that's happening in these areas which address specific functions and personas. If you think about your point around marketing services, the CMOs are clearly spending a lot more, and there's a technology intensity that mandates driving around these specific platforms. So we'll continue to see some of the platform work become more industry specific as it scales. Followed by cloud services, which includes everything from infrastructure as a service to platforms and SaaS or software as a service. This is where we are starting to see cloud value realization, industry cloud, and FinOps become important characteristics of driving the next generation of cloud spend. This isn't to say that data and analytics will witness low growth. It's just that relatively we see some opportunities there which are specifically around data engineering, data ops, and also this fillip that generative AI is providing this market. A lot of clients, when they think of AI, I think they have an AI issue. When they embark on that, they realize there's a data issue. So I think we'll see a lot of data plumbing work still. And then workplace and data centers, bring up the bottom of the pack. Workplace, we saw again a one-time ingestion of funds during the pandemic as everybody pivoted to a remote or a hybrid first environment. Some of that is just naturally petering out, and our expectations from hybrid work are very different now. And data center services of the legacy infrastructure management space continues to be a space where, as more movement to the cloud happens, the ability to maintain that moat reduces. Akshat, are we seeing something similar on engineering as well?
Fairly similar, though, given the nature of spend, first of all, in general, this market has, over the last many years, seen very decent growth, right? In fact, this year is a bit of an exception to the general rule of growth that we've seen being applicable across many years of the last decade. But that said, the way we are expecting this industry, hopefully coming out of this current year of super slow growth is, first of all, on the software product side, the hope is that some of the spend will come back. This particular year has been significantly low from a spend standpoint on software products, but we all know this is an industry which is fairly agile. Recovery, in fact, has already started at a certain level, so we feel the spend might come back and will again be the leader from a spend standpoint within the engineering services fold. Though the nature of the spend will definitely change, it will continue to be value driven compared to how it has been, way more optimistic and forward looking in terms of what the spend looks like. We'll also hopefully see a lot of first time outsourcers driven from the from the standpoint of optimizing on cost. Offshoring will become very important, and a lot of first time outsourcing in the software products area might be an opportunity for many to look at. Second, in terms of the industry 4.0 spend, this is another area where we continue to see spend even during the current time frames. It continued its relatively a moderate growth pace, which in this current climate was a good spend area. But in the industry 4.0 space, the way we anticipate is the pragmatic spending, which is in areas where a lot of direct return on the investment will be available. The spend might continue to happen, and then add to that the whole China de-risking agenda, which has been playing out over the last few a lot of Industry 4.0 spend in other regions across the globe might lead to continued spending. On the network front, largely where the spend was supposed to happen over the last few years was the 5G engineering area. But given the lack of appetite to spend over the last few years, this market has been somewhat slow. The hope is that hopefully as we come out of this relatively slower economy, the 5G spend might come back. So we might see a bit of a growth on in this particular market as well. Embedded, while we've put it here as a moderate growth area, actually this has been where the market has been most resilient in 2023. So hopefully it continues that way. So a lot of motion towards building connected products, smart digital connected products. This is where the nature of the spend. This is what it will look like in this area. And lastly, hardware, which is not a relative priority anymore. It's more the context spending. So we don't expect that to change. So the usual slow pace of growth in this arena will continue to play out in the next year as well. I want to touch upon another angle from a growth standpoint, which has a bit of a geo flavor. So if we move on to the next page, this is the APAC market that we want to talk about. It's applicable across ITS, BPS, and AS, though the engineering flavor is relatively more significant here. Look, first of all, the APAC market is no more the poorer cousin, so to speak, in the global scheme of things, right? From that standpoint, it has its own critical mass now. It's no more a small spend segment, and more importantly, the growth rates are significantly higher compared to the North American and the European spending, right? Add to that the fact that this year has been slow in the other two geographies. So APAC has suddenly risen to be one of the most prominent area, right? You see some of the stats in the screen where it's clearly visible how the leading geographies in the APAC market, India, China, Japan, are much better off compared to the global leading spenders like US, Germany, and UK, right? So it's a great geography to be in. It's a great geography to strategize towards, given how the spend has been evolving, and associated to that, a lot of provider activity is also very visible, right? Investments in the form of leadership focus, investments in the form of center of excellences or acquiring firms which are local to these geographies, which is very critical to actually scale in geographies like Japan and some of the others. That has started to be very visible, and I don't see that changing in any way going forward. So even in 2024 and onwards, this will continue to be fairly important area for companies to focus on. Right. So moving on to the next key theme. So this is the platform-led services model. So the key thing to look at here is the fact that enterprises have understood that platform-led business models and operating models are going to be critical for their success, right? It's almost a competitive significance that they have to invest into these areas. It's a business priority, not just a tech priority anymore. And from that standpoint, we see a lot of companies investing into platforms. Let me invite Nitish to walk us through some of the details on what this opportunity looks like.
Absolutely. And I think, very rightly said, Akshat, I think we see 2 or 3 things happening as a result of that. One, I think, clients want to build from more platforms, to my point around the platform economy earlier versus products or siloed point solutions. And that is resulting in a couple of observations in terms of who's funding these initiatives and how are, and the organizational design choices that large enterprises are making. One, is the fact that the CIO role is more important now than ever, right? I think the death of the CIO has been talked about for a number of years. We believe the role of the CIO is moving from an age of policy to an age of influence, because, a few years ago, we saw a bunch of these new roles around CDOs, chief digital officers, chief customer officers, and there were different terms around that, but were digital or ad hoc teams sprout in the enterprise. A lot of them have now reduced in terms of decision-making authority, or frankly just been merged into the CIO or the CTO office. Because what a lot of people realize is, if you just put a CDO or a digital COE, which is separate from your tech and business process and engineering team, without any A, accountability, and B, budgets, it just means that, the team's effectively making a lot of fancy presentations, emerging tech experiments, and speaking at keynotes. So we really need to have accountability and budgets to be able to do this. And that's where we saw some of that getting consolidated under the CIO umbrella. But the second and the more important thing is the emergence of these digital journeys that business units want to own for themselves. So, we roughly see in the CIO landscape in terms of IT budgets, about 40-45% of that budget is managed services, typical spend that the CIOs need to run, but also optimize every year because the CFO is asking for cost takeout. But then they're getting an additional spend, the rest of it by their business units, which is increasing at a faster rate than the decline for the former, because business units want to own their own digital transformation pathways. So this is both, how do you think about the future of sales and data-driven sales, from how do you become more customer-led through better data-driven marketing. So business units are actually getting a seat at the table, and it's becoming a multi-influencer buying cycle. So the fact that these platforms are specific to these business areas is necessitating that shift. In fact, when we think of software-defined platform operations, that's a key manifestation of this trend, where again, as I said, people want to build through platforms, accelerate time to value, not necessarily individual products, which are difficult to integrate, have different shelf lives, and also different levels of support. So we're starting to see this orientation around a few critical competencies in the enterprise, and how do you focus on either being DevOps-led tech, data and analytics, design thinking, up till tech-infused business ops. But these are then the responsibility of a specific platform owner, which is accountable for that end business outcome. So this solves for two things. One, innovation is not happening in silos. And B, you're not just thinking of process or system level metrics or SLAs or KPIs, whatever you might call it, but you're really thinking about the organizational's OKRs, which are the objectives and key results. And again, these platforms can be for customers, can be for partners, can be for employees. You can even extend that to say this can be for society, given the focus on sustainability. So in summary, what we're starting to see is, platforms allow for better access to market, increased time to value, also more efficiencies, because most of these cases you have an underlying data model, so you're not repeating data in silos. But it requires some radical organizational design choices and incentives to make it work. As a result of that, we're starting to see 4 sourcing tracks in enterprise customers, right? So this is really based on the fact that they're not trying to take the same approach for all separate objectives. So, we see enterprises are trying to modernize legacy, where the main mindset, the North Star really is reducing OpEx. We still see the CIO to be the key stakeholder, and it's going to be a very aggressive asset takeover competitive play. If you're a provider and you find an enterprise or a stakeholder in your enterprise client which is looking to modernize, you're more often than not see the CFO involved. But it's not just about saving, but it's about saving from one part and investing in another. So how do you have a series of these small Lego block or small T initiatives? Then we have mature digital, which I think is one of the more exciting parts of the market right now. This is all these initiatives that people started on some platform operations, cloud-based journeys, data ops 5-6 years ago, but now need a second lease of life. This is where, from building, we're thinking about how do you operate in the digital environment, right? We don't think digital transformation is a credible buzzword anymore. It's really about how do you operate in this post-digital economy. Here, the main difference that happens is the stakeholders really the business, which means as a provider, how do you communicate the value and how do you frame the value of what you're doing changes. It can't be, again, the same metrics we spoke about. And it goes to the point around OKRs or objectives and key results, which we believe is a way to differentiate in terms of solutioning. And then the last sourcing track or objective we see for enterprises is around AI. Now, yes, we'd like to pretend that, everybody started this AI journey on the 30th of November last year when ChatGPT came in. But all of us know that we've been on this AI journey for a while. Generative AI, I do believe, is a secular movement for the industry, which accelerates this journey. So what we are seeing is clients want to move from what we are calling a plus AI to an AI plus journey, which is don't sell me all the offerings as a provider and also now sell AI, but can you embed AI in all the things that I'm doing and help me understand where do I start? And that's where we clearly see this mandate being driven from the CXOs. We're starting to see early evidence that 1-3% of the IT budget is being given to CIOs, even in this tough economy, as a one-time war chest for Gen AI. But they're being asked to do 2 things. 1, do it quickly. 2, do it safely. It seems counterintuitive, but it's not. So I think, the implication of this slide is, as we move to a platform economy, recognize where does this apply for your customers? How do you want to play that based on who's driving the decision and what do they care about? And then think about how do you differentiate. Now, as we do this, it obviously creates different imperatives in terms of what part of the life cycle you want to focus on. So, Akshay, do we want to talk about how does this bifurcate by different parts of activities?
Sure. Yeah, and I'll keep it very, very quick, right? I think this is another take at the whole platform's opportunity. So essentially, the point that we want to drive here is that, look, typically you associate platforms with the opportunity to build something for the enterprises, but there is a very significant part of that opportunity which lies in both the operations, which is more day to day, as well as the management, which is relatively more longer term, right? And as you can see from the segmentation, nearly 35% of the overall spend lies in this zone. So if the focus traditionally has been only to look at the spend to engineer something for your customers, you can quickly realize nearly half or more, of what you were currently drawing as revenue from these offerings very quickly if you start focusing on these, right? The other thing to highlight here is that this obviously has a certain degree of managed services component flavor, or in a way annuity stream of revenue attached to the two new areas that I'm talking about, which is operations and management. So while engineering may be more here and now, but it is generally a one-time thing. But operations and management can create a much larger and ongoing stream of revenue for companies who choose to participate. I think the key thing to realize here is also the fact that the firms who support customers in engineering are generally the default choices to support on operations and management as well, given all the contextual knowledge that remains, right? So from that standpoint, it's a business for you to lose. If you're not able to take it, it's something that you are doing wrong. It's a disservice to your own self. So this is something that has to be strategized towards right from the day one, and the deals have to be formulated in a manner where operations and management spend is also looked upon as an opportunity from the very beginning, right? So okay, moving on, let me invite Shirley to talk about this whole phenomena around portfolio rebalancing that we are seeing across multiple industries and segments. Shirley?
Yes, so the third demand theme is about portfolio rebalancing, and based upon our research, it's not surprising that this is a trend, given that satisfaction from enterprises with their providers have dipped quite considerably. We're hearing across the board that the goodwill that providers earned during the global shutdowns is wearing off, and buyers or enterprise satisfaction is dropping down to levels that we haven't seen in the last few years. And so this means that many organizations are considering their options. And these options include, if you see in the next slide, rebalancing of their portfolio, as well as consolidating or rationalizing those providers that they use. So for providers, in order to preempt these moves, you must have strong account management capabilities. And if you do so, this will provide a competitive advantage. We all know that the cost of changing providers can be substantial for your clients in terms of change management alone. So through account management, you're giving them a reason not to explore this as an option. All right. Moving on to demand theme 4, and I'm going to fly by this equally fast. Clients are really focused on their GBS, or global business services, shared services strategies. And there's an opportunity for providers to do so as well. When we look at organizations, they typically fall into 4 buckets when it comes to the leverage of GBS or shared service models. And it really depends on the pressure that the parent organization is under, as well as the challenges that internal teams have in delivering services. When organizations are facing many challenges in in-house delivery, they typically consider increasing the leverage of third-party providers. And in these cases, high business pressure is leading organizations to consider third-party providers are even carve out of their GBS organizations, while lower business pressure still creates a demand for third-party support, but mainly to help shore up internal GBS or shared services capabilities. And our data actually says this. When companies or enterprises are looking to set up new GBS organizations or centers, they're increasingly seeking third-party support in doing so. Of the 35 to 45% of offshore GBS center setups assisted by providers in the past 5 years, the majority are still virtual or assisted. But there is still a strong increase in build, operate, and transfer operating models compared to the previous 5-year period that we measured. Also, on the right-hand side of the slide, we are seeing a substantial increase in the number of GBS carve-outs. This happened in the past during the global financial crisis, if you remember that. And we are seeing the same trend now in this period, this current period of economic uncertainty. All right, Nitish, over to you on generative AI and sustainability.
Yeah, absolutely. Sorry, and I think, as you said, it's a surprise that we've had a conversation this long without talking about Gen AI already. So we'll again focus on the key messages here as we try and do some Q&A. So one of the things we're starting to see is, the Gen AI moment is really a secular moment for our industry. I think the first 6 months since November last year, people are thinking about the fact that, is this real? Is this another fad? Is this another blockchain or the metaverse moment? I think there is enough consensus in the market right now that the technology is ready for prime time. There are lower barriers to entry for this technology than some of the other recent technology hype cycles that we've seen. So yes, there is enough that people can envisage in terms of use cases. I think now the question is, where do clients start and how do they do it? Now, we see 3 categories of Gen AI use cases, right from being embedded within, broader enterprise applications or things like taxonomy and search. That is where, if you think of Microsoft's Copilot framings, somebody else calling it a sidekick, every other version of that, it's really with this view that, hey, Gen AI and Gen AI functionalities will be embedded in many enterprise applications and it helps improve productivity. The second is, a category where we are thinking of customizing specific use cases which can take the benefit of Gen AI. This is really around a lot to do with content and customer service, right? From marketing and promotions to customer service, code gen and testing. And then there will be a set of strategic use cases. So think Bloomberg GPT, Pharma GPT, Legal GPT, where some of these technologies based on the transformer model become industry or function specific. Obviously, we see a majority of the use cases around the embedded use case category right now. So there are certain, so I think one of the key questions you should be helping your clients understand is, where do they start and how do they start? With Gen AI, one of the things we see CIOs dealing with is they don't have time to create a 2-year roadmap. The boards are asking them to create a 30, 60, 90-day roadmap. So how do you help them get the early wins is really, really important. And then, making sure that you can help them understand the governance and the change management required. I think the fact that safety and risk is still such a fundamental issue with generative AI is going to remain for a while. I think this will require regulators, legal authorities, everyone else to come along, and not just the private sector. So we see that consensus to be some time away. But in the meanwhile, how do you not let that become a bottleneck for generative AI adoption? So right from identifying use cases, helping them assess risk, finalize specific use cases which are low risk right now. How can they source for these technologies? Right now, generative AI is quite expensive, both at the foundational model, the compute level, as well as an application level. So how do you help do that? How do you evolve the operating model around generative AI? Contracting will be a big thing because, nobody's figured out how do you contract in a world where your provider takes less time to do the same amount of activity, and then ultimately assess business impact. So the short message on generative AI is, your clients don't need to be sold on this. They're already sold on it. How do you help them start on that journey and help them govern and curtail those risks are really the 2 big opportunities as a provider in this landscape. Now, having said that, we have some early data around where clients are thinking about this already, right? So we run a lot of our surveys and key issue studies. And if you think of the adoption for generative AI based on a recent poll, which is on the left pie chart, we're starting to see early adoption. More than a third of the clients he spoke to, and these are largely Fortune 1000 companies, are running or planning to run a pilot. In fact, if I think about the slice of the data within that, which are actually running a pilot, that number would be nearly 1/4 or 25% of all respondents. So it's a fairly significant chunk where people have put that small chunk of change, as I said, on actual implementation. We see about 28% of clients saying we've actually integrated generative AI in 5 or fewer processes. So yes, there is a small sliver which is on the fence, but I think for a large share of the market, people are actively either starting with pilots or putting actual money, not just free implementation, but or are in early stages of thinking about how they scale. In terms of budget allocation, it's really interesting. I think a majority still comes from, on a use case to use case basis, but most boards have asked their IT and business process and engineering teams for Gen AI roadmaps. And then, we are starting to see some specific funds also being carved out, to my point earlier. Now, that's one big secular theme, which is being embedded across everything. The other big thing that we still see in the market and sourcing is sustainability. So, Akshat, what do we see there?
Yeah, so sustainability clearly over the last few years has risen to become one of the most important, even board level priority, I'd say, and that definitely translates into spending in terms of services across business process, IT, and engineering, right? So that's quite visible in terms of some of the data points that you see on the screen. On the left, you see a lot of actual activity which we've captured, where you see that the ESG focus shows up fairly significantly. In fact, the way we see it is 56% more outsourcing deals included an ESG component in 2022 over 2021. And that continues to happen. We'll have a refresh on this data fairly soon, but that has continued to happen in 2023 as well, right? The other key thing that is important for us to realize is that sustainability is also seemingly to an extent recession proof, at least to the extent that we are in recession already, right? If it worsens further, who knows, where this would go, but at least so far, it has been recession proof, and that's directly based on a lot of our direct conversations with enterprises. You see towards the right how marginal decrease or significant decrease has been chosen by very few firms when asked about how do they plan to look at their spending from a sustainability standpoint, right? So as it stands today, if you look at the themes of expenditure in the broader sustainability or ESG arena, most of the spending today happens around monitoring, around tracking, and then associated IoT or data analytics related initiatives. Where we see this happening in the future as it rises in priority even further, as we go further into this decade, we feel an energy transition, and whichever way it impacts the different industries that it touches. Then material choices in terms of how do you build your products in a more sustainable way, and then the closing the loop with circularity, right? How do you create your value chains more circular? These three themes, which actually take a significantly higher capital expenditure to make a reality. We'll see more spending on these themes going forward. Okay, so that's a quick take on sustainability. So we have so far looked at a lot of trends which are shaping 2024 in our opinion. At this stage, what I'd like to do is very quickly take a sense check from the audience on how are they feeling about 2024, right? Similar to how we checked earlier on 2023, it'll be good to know how people are feeling about this. You see a question and a few answers on the screen, so we'll give it another maybe 20 seconds and see how it's already very interesting how it's shaping up. So let's give it another 10 seconds.
Yeah, I'm quite curious to see whether we have an optimistic bunch or do we still see some overhang of the first question.
Yeah.
I think people are getting tired of being pessimistic. It's exhausting, isn't it?
Yeah. So the way I see this is there is nobody from the audience has actually picked highly pessimistic. There's a significant majority right in the middle, somewhere around the neutral and somewhat optimistic zone, and a decent 15% said they are highly optimistic. So I don't know, Nitish, surely how you'd put it. I would say this is cautious optimism. That's all people can muster at this stage, but that's not bad. So, well, I mean, aligned to this, what we intend to do, if we go to the next page, we want to understand this more. We want to understand what are the specifics in terms of how people are approaching 2024. We actually run this whole program called Key Issues Survey every year towards the end of the year to understand how people are feeling about their businesses, what are their priorities, what are their sentiments, etc. So we're going to do this again towards the end of this year. Actually, this will go live fairly soon. And this survey, goes out to all enterprises as well as service providers to understand their business priorities, their spending propensities, the issues that they anticipate they'll run into, what kind of spending that they might end up doing. So as we do that, we'd encourage you to participate and share your perspectives as well, as this gets launched. Second, of course, as you sign up and participate, you'll be able to access the findings too. And we'd also be doing a webinar dedicatedly, around the results that come out of this program. So, we welcome all of you to participate as we get to that. So very quickly, look, like I mentioned earlier, we have so far understood what 2024 would hopefully look like based on the trends that we see. We'll in a moment talk about what we feel might be important actions that service providers should look at. But just before we do that, we wanted to call out something that we wanted to offer all the esteemed leaders who have joined us in the audience today. So as you get into planning for the next year, we would like to offer support to the executives to discuss a lot of their imperatives, objectives, and strategies getting into the next year, right? So you can request a complimentary 30 minutes discussion through the link that should be now available in the chat. It's meant for senior executives, and it's applicable and available to both enterprises and service providers. Okay, so we encourage all of you to reach out. We'll be more than happy to have a dialogue and figure out how what 2024 will likely look like for you, and if there are things that we can do to assist you in getting into the next year in a good shape. Okay. So let's get into the last part of our discussion today, which is around actions to plan for 2024. Nitish, let me invite you here.
Absolutely. Thanks, Akshat. And just to bring it home, we believe that there are, 6 critical elements and you need to think about as you plan for 2024. If I look at also some of our incoming Q&A today and some of the pre-submitted questions, it seems like a lot of the audience is thinking in this direction already. So we start with sourcing themes, which is what's top of mind for clients. I think clients are having a really hard time reprioritizing initiatives. So you want to make sure you address their critical demand themes as we walk through, the leading ones today. Some industries are more impacted than others. So how do you make sure that you take the appropriate value proposition to those industries? Some industries are going through a very fundamental shift in terms of new consumption model, new consumer preferences. You want to make sure that your approach is tailored to what that industry needs, and thereby which client and stakeholder in that industry you're targeting. We spoke a lot about accounts today. We do believe in the short to medium term in IT, business process, and engineering services. The most short way of success is distinctive account management, knowing your accounts well, and also making sure you're positioned in new stakeholders in those accounts, not just the ones you're used to, because we're definitely seeing a more complex and multi-stakeholder buying cycle. So make sure your account playbooks, your account intelligence, and stakeholder analysis is top-notch. We will see investments in the market. This we have seen in previous downturns as well. It doesn't mean that everybody curtails investments in all areas. So we're starting to see increasing focus on M&A. Shirley spoke about divestitures and captive buyouts. We continue to see a lot of asset-based deals right now. How do you make sure you can identify the right investments where you'll grow, not just follow the puck, is going to be very critical. Competition, I think, as somebody famously said, right, only the paranoid survive. So how do you make sure you are ahead of what you're seeing with your peers and making sure you're a step ahead? In some ways, yes, you want to be a fast follower, but some areas you will have to think about market making activities, and your solutioning, your messaging in areas like Gen AI, sustainability, trust, and safety become really important. And then it's all about the ecosystem. As we spoke about earlier in the platform discussion, there are certain places where client tech stack choices are limited to a few options or are getting consolidated with a few large vendors. How do you make sure you can educate those partners, not just from a channel perspective, but also an innovation standpoint on what you can do together? And that is also key to creating more pre-RFP influence in some conversations like cloud. So those are the elements which, again, in some shape or form, I'm sure people are thinking about. And then, as a quick illustration of what Akshat mentioned in terms of how we can help, here are some ideas on how we are already working and our teams are working with providers, both in terms of identifying and pivoting to these high growth, future ready segments to drive profitable and sustained growth, as well as capturing client mindshare and shape their thinking in some of the more market making activities that we see in certain areas where clients often are dealing with the unknown. So having said that, I'm going to quickly come to my favorite part of these discussions, which is really Q&A. And, I'm going to say one thing at the outset. I don't think we'll be able to do justice to all the questions streaming in today, even if we got ChatGPT to do it. So we will follow up. And we also want to take some pre-submitted questions. So Shirley, over to you.
Yes. Thank you, everyone, for sending in your questions in advance and also live during this session. Many of you have sent us some questions in advance regarding, the economic outlook. And as Akshat said, we are going to be addressing these within our key issues study that's coming up. The link to that survey is in your webinar chat window. So please do take that survey and you'll get a summary of the results. And of course, we'll be doing another webinar before the end of the year to share the results back with you. Also in the webinar chat, there is a link for you to take advantage of that complimentary offer for you to have more discussions with our analysts around your strategic and business plans. And we can dive into a bit more detail on any of the points that we've been discussing here today. But just to kind of kick off the questions, I think we have time for maybe one or two questions. I'll direct the first one to Nitish, and this is from Kuldeep today. Where do you see IT service firms focusing on in terms of making themselves more relevant and getting ready to serve the upcoming market needs?
Yep. Thanks, Shirley, and thanks, Kuldeep. And I'll try and do justice to this in a minute. So I think we see two broad areas where IT services firms are making more investments to drive this. And I think when I say this, I'm going to put a time frame of the next 12 to 18 months, because I think some of those current market conditions are still going to prevail in that time frame. One, I think, is how do you help clients with the zero cost takeout, or what I call financial rebalance between CapEx and OpEx. So I think there is a bunch of initiatives that IT services firms are driving, from what we saw earlier in terms of captive takeovers, carve-outs, build, operate, transfer models, rebadging. So we're starting to see those deals, which are not necessarily new for IT services, has been done previously as well. But I think there are new pricing and deal behaviors that are driving that. So we are seeing a lot of that. It also impacts things like AMS or application management. And how do you help drive down the cost to serve for IT fundamentally? So I think that playbook still has a lot of shelf life in this current market environment. I think the second area where we're starting to see a lot more work, and specifically helping drive some of the more upfront consulting work, is really new revenue models. This is something which is specific to some sectors which are focusing on new monetization models. But, again, clients are dealing with those unknown unknowns. So, are they now going to target new end user customers to get those revenue, get that revenue? Are they going to have to think about new ecosystem partnerships, right? So electric charging is a great example where, upstream and downstream, it's a very complex environment and you need to build a data platform to do it. So my advice would be, on those areas, identify the industries and specific clients which have a fundamental shift in terms of the revenue mix coming in, and how do you help enable that through, better data-driven decisions, maybe an AI platform, also means a modern platform backbone. I think those are the two areas where we see, in the short to medium term, a lot of focus from IT service providers.
Thanks, Nitish. I think we have time for just one more question, and this is from Jeff Blair, and I'll direct this to Akshat. Do we see any differentiation in platform spending trends when we're comparing large enterprises versus mid-market?
Sure. Thanks, Shirley. And Nitish, I'm going to invite you as well to offer a perspective on this one. Though let me kick this off, right? So I think first of all, both of these markets we see in the current climate spending a little more in sustaining what they have versus creating something net new. So that's actually common. That's not how they are differentiated. But thought I'll highlight because that's an important observation as you approach this market from an opportunity standpoint. Though in terms of how they differentiate, from my vantage point, I see the mid-market offering a greater opportunity to service providers to support on ops and management. Large enterprises typically feel they are more competent and comfortable to own some of that up, especially the management part. Though operations and maintenance might still be available for take up from third parties, but large enterprises typically feel that management of a platform and understanding what the roadmap should look like and what form and shape it should take in the future is something that they keep relatively closer to the chest. Mid-market firms can be considerably more open, especially in industries which are by design not really large tech houses, right? So industries like retail, healthcare, banking, in the mid-market, there might be a bigger opportunity there. Nitish, anything you see differently?
Well, if I could only figure out the mute button. No, I think you covered it well.